All right, welcome back. So when we put together a plan to not just kind of make it through the next 6 months, but to win in the next 6 months, we start to think about what are our action items, what are our new daily habits, what are my conversion ratios so I can factor that in, how many appointments do I need to go on, how many contracts do I need to get signed, how many closings do I need to have. In order for us to plan for where we want to go in the second half of this year, we need to first understand, and this is an often misstep in the business planning process, we need to first understand and get real with where we're at right now. Because for many of you, if you had a chance to catch the 2023 business plan that we launched, and you're going to see the new one as we go through the conference for the second half of the year, we spent a lot of time talking about you have to first know where you're at so that way we can compensate, right? If, for instance, if sales are going to be down by 30%, and we want to do the same, which I don't think many of you in here have a goal to do the same. I think most of you all want to increase every year. But if sales are down 30%, well then that means I need to take 30% more listings, for instance. And if I'm needing to take 30% more listings, then I have to go on 30% more appointments. And if I have to go on 30% more appointments, then I need to set 30% more of what? Appointments. And then if I need to set 30% more appointments, then that means I need to have 30% more contacts. Well, in order for me to have 30% more contacts, I need to have 30% more leads. So in order for us to business plan for the second half of this year, we need to first have a really good understanding of where we're at today and hear from someone who their only job is to study the economy in the market. So we can truly understand where we're at now, so when we're putting our plans together, we know what we need to over or under compensate on. And so we're going to spend the next 20, 30 minutes or so going through an update on where the economy sits today. And we do this not necessarily every event. We probably skip, we do this every other event. And we decided to bring back Dr. Lawrence Yun, the chief economist for the National Association of Realtors. He's going to be joining us live on the screens here in a moment. We decided to bring him back because it's been a minute since we've had an update, and we've been living in this new economy for now about 12 months. I mean, this market really started to get wonky on us last June. And so now that we've been living in it 12 months, let's take a listen from someone who knows it better than any of us in here, because it's his only job is to study the market and predict where it's going. So that way afterwards, by the way, before we go to lunch, we're going to get into a segment called Make Your Own Market, where we're going to take what you have just heard and what you're going to hear in a moment and now apply it so that way we can go out and win with it. Because here's the last thing I'll say before we bring them on live. The difference between the average and the greats. The average hear what's going on in the market and they think about how it's going to impact their business. The greats hear what's going on in the market and they look for opportunities to win and solve problems. So as we're going through this next segment, I want you to think about where your opportunity to win, where your opportunity to solve problems lie. Because this isn't just doom and gloom and, we got to be informed. Yes, we have to be informed, but also we got to look for opportunities. And so let's go ahead and first get started with learning where we're at today and where we're heading. So if we could have Dr. Yun on the screen, and then when we see him, let's give him a warm welcome, Dr. Lawrence Yun. Welcome, Dr. Lawrence.
Hello, everyone.
Dr. Yun, the floor is yours, my friend.
All right, great. Thank you, Jeff, for inviting me to participate. And as you said, the economy has changed in the past 12 months, certainly with the fast rising mortgage rate. And the housing sector is the first sector to respond, and often in a large magnitude. So we saw that sales have come down throughout the past 12 months in many regions of the country, 25%, 30%, and I think I saw in December figures, December versus December the year before, some places down 60%. So it was quite a transition. Now the market is still down, I would say roughly 20% from 1 year ago, but the second half of the year, I believe that we're going to see a year-over-year gains. Now, of course, last year's second half was not that great, but nonetheless, compared to last year's second half, I think things will be a little better this year versus then. First, let me just say that I may be interrupted. I don't know. The librarian is saying that I should be all okay. I'm at a public library, by the way, America the Beautiful. Just in case you are out on the road, which I happen to be, all the public library have very good Wi-Fi, so you can stop by to listen to. So I'm using a public Wi-Fi as I'm traveling out on the road. So, great thing in America where you have that access. But let me go into the what you can expect based on the economy. I can only speak better with PowerPoint slide, so let me put that onto the screen. So hold 1 second. All right, so this is the Federal Reserve policy on their interest rates. This interest rate is not for you and me, it's for the banking system, but it still drives the overall mortgage rate direction. So what I have on the chart is starting from 2019, pre-COVID, and then when the ugly COVID arrived to the country, as you can see, Fed lowered the interest rate to the absolute minimum level, essentially zero interest rate policy, which brought down the mortgage rate to 3%, or in some cases, a little under 3%. But look what happened in the past 12 months. The unreal activity that was happening on the interest rate. Most aggressive interest rate increase since the early 1980s. I'm sure some in the audience were not even born in 1980. So this is the most aggressive interest rate policy that some in the audience have ever seen in their life. So this fast raising rate essentially flipped the housing market upside down. Now, there is a possibility the Fed is done with raising interest rate with rate cut by the end of the year. Fed last week, their policy said no change in interest rate. First pause in 12 months. So that's good news, first pause in 12 months. But they did indicate they may raise interest rate 2 more times before the year finishes. I think that's a wrong decision to consider. I think if anything, they should be cutting interest rate, and here's why. They're focused on inflation, and inflation is beginning to calm down. So pre-COVID, inflation was a non-factor. We were just living our life normally. Then you see this strong run-up in inflation, and Federal Reserve panic, and therefore they aggressively raise interest rate. But look at the direction of inflation. It's beginning to trend down. Egg prices, which was a huge headache several months ago, now the price of egg is a little lower now compared to 1 year ago. Gasoline prices, still not pleasant, but it is still a little lower compared to 1 year ago. So inflation is trending in the right way. And given this trend, I would say the Fed needs to pause or possibly cut interest rate by the year end or early next year. And here's another indication on inflation. The blue line that you see is the same line. So let me just go back up. By the way, you don't have to take a photo, you don't have to copy anything, because I'm gonna send these slides over to Jeff and he's gonna distribute all to the audience for people who want it. But this same blue line, I'm gonna put it on the next graph. So the blue line is the inflation. The red line is people's wage growth. So pre-COVID, people's wage growth were above inflation. Your standard of living was rising. Your client's standard of living was rising. Then we were hit with COVID, the green box. So massive stimulus, a lot of money going out. So people's income actually were pretty good. Then the payback time. Inflation outpaced people's wage growth, so our standard of living were actually falling. So whatever wage growth we did, you go to grocery store, you ate up more than what your wage growth was. But now we begin to see that 2 lines are beginning to merge together. One interesting part on the inflation number, if you look under the hood, look at some of the subsector, subcomponents, is the rents. You are a real estate investor, you have done pretty good. Rents were rising strongly. But be cautious. I think the rents will no longer rise at an aggressive pace. It will still rise, but not aggressively like 8% rate anymore. And the reasoning is the rents, which is showing about 8% gain, I think by the year end, it will be much calmer, like 4%. Why? Because we have a robust apartment construction. When you see a construction crane in your city, it's probably related to apartment construction. It is at a 40-year high. So many empty units ready to hit the marketplace, so there will be more competition to attract tenants, given all these empty units coming onto the market. But regarding rent simply cannot rise this fast when we have so robust apartment construction. That means a strong measure of inflation will be coming down. Simple, more supply of apartments, rents will begin to be not so strong, it will calm down. And if that calms down, overall inflation will calm down. And if the overall inflation calms down, then the Federal Reserve can cut interest rates. So cutting interest rate, I think, is a certainty next year. I just hope they make the quick decision and do it this year, later this year, maybe November and December. Even though they indicated they want to raise interest rate, I think that's a wrong thing. As they see some incoming data, they will see that inflation is much calmer, giving the Fed opportunity to cut interest rates. So let's look at some of the key components. Let's start from the bottom. I know that the gasoline prices are up. I mean, it's certainly much higher compared to pre-COVID, but compared to 1 year ago, it is a little lighter. I know some of you do not believe it, but it is above pre-COVID, but compared to just last year, it is a little lighter. Airfare also is a little lighter. No increase in medical service. Clothes price up 3%. Then you go up the line and you see that food prices, you go to grocery store, it is still not behaving. It is still up 6.7%. Rents are rising 8%, but that will begin to calm down with so much apartment construction. But the big increase, car insurance. What's happening here? Vandalism. In many big cities across the country, teenagers, others are smashing cars, and somehow they get arrested and they are released and they do it again. So because of that, all of us, whether we are impacted or not, we are paying a little more in terms of car insurance. Nothing is free. So right now, unless somehow we begin to really be strict on some of the vandalism that's occurring, expect more higher costs on car insurance, which means higher inflation. Higher inflation means higher mortgage rates. So all this is filtering in. So if we can reduce vandalism, at least it will make, through the logical connection, mortgage rate, it could be even lower if that's the case. Let's look at the housing market. This is the home sales activity. I put the line in the middle to indicate COVID arrival. So pre-COVID, very stable home sales. The wild gyration since COVID. Lockdown cut the sales, but when the economy reopened, record low mortgage rate, people wanted to take advantage. But look at the recent 12 months. Down, 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 down. Exactly in the impact of rising mortgage rates, rising mortgage rates, rising mortgage rate, to show the sensitivity of the home sales to interest rates. So if the Fed can cut interest rate, expect buyers to come back. Are you prepared when the buyers come back? So right now, you see the sales activity. Another thing to note is, look at the figure in the latest versus pre-COVID. It is below pre-COVID. It is below. So we had a boom, but right now the current sales activity is below pre-COVID. And let me contrast that with home builders. This is home builders. Same line, pre-COVID, post-COVID. Look at the current activity. Current activity is actually back to pre-COVID. So the builders are actually doing well. In fact, the builder stock prices are up 50%. Lennar, KB Homes, Toll Brothers, their stock prices are up 50% because they are generating profit and they see a strong demand. So what is the difference between existing home, your client's home that is ready to sell, versus the home builders? Well, here is the graph. Inventory. Left-hand side is the existing inventory, which is at a historic low. While on the right-hand side is the newly constructed home builders inventory, and as you can see, that's plentiful by their historical standards. So it's not only mortgage rates, but also inventory availability. So if we had more inventory, then we can get more sales done. One of the things that NAR is doing in Washington is to talk to the members of Congress to say, let's incentivize more listing to come onto the market. How do we do that? Well, consider real estate investors. They have made some good profits, but they want to cash out, they will be hit with capital gains tax. But what if we reduce capital gains tax temporarily or even make it zero over some temporary time? That will make many real estate investors to list their property, and we could make it conditional to say that if it is sold to first-time buyer or for home ownership or first-generation buyer, you can put some kind of condition, and so that we have more inventory showing up to the market. Because it's not only mortgage rate, but the inventory availability that's limiting sales activity. So I am hopeful, I should say that at least we are in conversation with Congress. I know they were busy with debt ceiling limit and all that kind of stuff. Well, that's out of the way, so hopefully they begin to focus on other issues that impacts America. And Americans are wanting to buy a home, but they cannot because of lack of inventory. So hopefully we make some movement on the inventory front. Now, prices have not really buckled down. So home sales have come down, but not prices. Except in San Francisco. San Francisco prices are tumbling because everybody wants to exit San Francisco. It's a disaster in San Francisco. Aside from a few cities, that you are essentially seeing stable prices even with the tumbling in sales. So prices are holding on and is near record high levels. And because of that, this chart you may want to show to any potential first-time buyer wealth comparison between homeowners and renters. Why should you buy a home? Well, people build wealth through home ownership. Look at your grandmother. Ask, at what interest rate did they buy a home? And believe me, they will say not 3%, 4%. They will say something like 10% mortgage rate when they bought a home. Was that the best decision of their lifetime? Yes, it was, financially. They build home even at higher interest rates. What about your parents? Well, their parents purchased their home when interest rates were 8%. So independent of what interest rate it is, people build wealth over time because prices steadily rise over time as long as we don't have subprime lending. So when you look at the home price graph, this is it. The portion in the middle when it declined, that's the subprime lending, those funny mortgages, no income documentation, and it simply blew up. Fortunately, we don't have those mortgages. People who are getting mortgages need to document their income, stay within their budget, so don't expect any home price crash. Maybe some decline, 3-4% after a huge run-up, that's possible, but view it as a temporary decline before going up again. A home ownership rate are gaining, at least it gained through the first quarter. I think the upcoming data will show that it's probably going to decline because sales numbers have come down, so there's a little lag time. But as you can see, it's not all equal among race and ethnicity, we want to assure that people, part of the American dream, people view it as ownership. Now, let me turn to the job market. With each passing month, more jobs, and we now have 4 million more jobs now compared to pre-COVID. But not all states are equal. Traverse City region, beautiful area, job creation is occurring. Job creation is occurring in Grand Rapids. Detroit is always a little sluggish in terms of jobs recovery, but they are trying to recover. So if you look at the state of Michigan, it's showing 0.1%, which is actually light. Because this is showing how many jobs now versus pre-COVID record high. So compared to pre-COVID, Michigan has generated virtually no jobs, while Indiana has generated 3.9% more jobs. So Indiana is doing well. Then you look at dark blue, like Texas, Florida, and the Rocky Mountain State, they're doing super well. So places like Austin or Miami, they're doing just super well. The orange color, they're still down. They have not fully recovered. So like North Dakota, they're not producing oil. Louisiana is not producing oil. Alaska is not producing oil. So they're down. And then you have like the New York, which is still trying to recover. But overall, Michigan is a little bit of a lagger in terms of the job growth. You may talk to the governor, why is it that the case? But you can see there's some variation across the country. Unemployment rate measures a different numbers, how many people don't have job and searching for job. So Michigan has unemployment rate of 3.8%, which is reasonably tight inventory, which means there are still help wanted signs. And if you need to hire people, you may have to pay higher wages. But Michigan has relatively higher unemployment rate compared to surrounding states. Let me actually go into the mortgage rate forecast. So mortgage rate, as you can see, 2019 pre-COVID, then 2020 and 2021, when we had a boom, low mortgage rates. But last year, rapid increase. And you say 2023, why is the mortgage rate a little higher compared to last year? Well, because last year, first half of the year, mortgage rates were very low. So if you look at the annual average, it's gonna show up as a little higher. I have it at about 6.3%. So current mortgage rate is 7%. So if average is 6.3%, what I'm predicting is, in essence, by the year end, mortgage rate will be lower compared to now. Right now, it's near 7%. I think by year end, it will be closer to 6%, and next year, it may be under 6%. So in other words, the worst in mortgage rates, I think, is already happening, and it's gonna improve, meaning lower mortgage rates. And don't just trust my word for it. I'm gonna convince you of it after this slide. This is home sales forecast. So blue is the newly constructed home sales. Orange is the existing home sales. That's my time marker to say 5 more minutes. So last year was difficult. It declined 18%. This year, first half of the year looks difficult. It's down roughly 20%. But for the year as a whole, I think the second half will see an improvement. So the total year will be down only about 10% overall before a strong pickup next year. So right now, essentially, is the most difficult, challenging market condition right now. Then things will steadily improve in the second half and going into next year. But the forecast on mortgage rate, why I believe it will go down. So these are some logical reasoning. First point is that I mentioned about the rents. Rent is a big weight to the consumer price inflation. Once rents come down, it's gonna cool down the broad CPI even more, which gives the Federal Reserve opportunity to cut interest rate. So that's one. The second reason is that right now the fast rising interest rate has killed off many small-sized banks. Silicon Valley Bank went under. Some Signature Bank went under. And many community banks are suffering, and I don't think the Federal Reserve wants to see more community banks suffering. So understanding this, I think they will be cautious about the damage they may do to the community bank. And finally, the last point is a little more technical, a little geeky. People who are data geeks love this kind of stuff, but let me try to best explain the possible. So here's the graph between mortgage rate. So red line is the mortgage rate, what you and your consumers are looking at, red line. Blue is the government borrowing rate. So US government is running a deficit, and they borrow money and they pay interest rate. Two lines move very similarly together. In fact, there's a little relationship because most US mortgages are government backed. FHA government backed, Veterans Affairs government backed, and even loans from Quicken Loans or Bank of America get sold to Fannie and Freddie, which is government backed. So because of the government backing, two lines move very similarly together. But put this graph under a microscope and you see something strange. This is the gap between the two lines. So the blue is the average, while the red is abnormality. Today, we are in an abnormal state. So once this abnormality disappears, once the spread begins to narrow back to normal, you have mortgage rate right now. Today's mortgage rate could be at 5.8% if the spread simply disappear. So with this in mind, I think the mortgage rate is going to trend downward. So mortgage rate, as you saw in the earlier part of graph, is the big driver for home sales. So once the mortgage rate steadily go down, home sales will pick up. We don't have supply, so we need to get more supply. We're trying to get a reduction in the investors' capital gains tax. Hopefully that will bring additional boost. But eventually, all the home building activity will also provide inventory condition. And I know some of your clients are saying, I love my 3%, I don't want to give that up. But they have additional child in the family. There are many life-changing circumstances. If the gap between their mortgage rate and the market interest rate is high, they don't want to move. But if the gap begins to narrow, then they would consider moving. So I think more people may be in the wrong house at the moment just because of low interest rate, but as soon as interest rate decline, they want to do that move. So potential pent-up seller coming to the market. So with this, best to you. I know Jeff trying to motivate you all, and I know you are just attending this session. You're all motivated agents. So best to you in the upcoming year. So thank you.
Thanks, Dr. Yoon. Thank you so much. Thank you. As he was going through, I was also thinking a lot of the value in that conversation gives you an unfair advantage over your competition, because when you can get involved in that level of conversation because of the knowledge, that actually will lead to higher conversion rates. So although we talked about how we got to know where we're at to plan where we're going, as I was going through that, I was thinking, gosh, I forgot to remind you guys, the other big value and reason why we would spend time taking a look at where we're at and listening to predictions from an expert is so that way when we're involved in conversations and buyers and sellers ask, so how's the market? Where's it going? And when you start talking and they follow up with, well, why is that happening? What is your response? Well, this is just, normal things. What goes up must come down, cliche type lines. Or can you actually have conversations around what's really going on? Well, here's why it's happening. Because inventory is lower, we have less homes coming on the market. That means less sellers are going to turn around and be buyers, which that, of course, then leads to less transactions, right? How often could you put yourself in a situation where when they ask you about the market, you not only can share a few legitimate statistics, you can also share your prediction and why. You can give them some background on why we're experiencing low inventory, on background on why the interest rates are doing what they're doing and how the interest rates are going to impact. Because as you just said, the conversation of, well, if I'm at a 3% rate and I move, then that means I'm going to be at a 6.5% rate. Getting involved in more of those conversations with clients and being able to give specifics will help you with your conversion rates of getting more people to say, yes, this is the buyer's agent I want to work with. This is the person I trust to list my home, because they don't just understand marketing, they understand the market. And when you can display that to buyers and sellers, you're more likely to get them to trust you with whatever it is else you say after you answer their question.